we've had a volatile day today. The market's been all over the place. The 10-year treasury stopped going up at one point. Does this mean it's finally time to start buying stocks? My answer to that question is an astounding no. While today may have been volatile and we may have ended the day on the upside, the day is not that important of a time frame. If you look at the year, we are very firmly in a downtrend. We are topping when we need to top, and we are bottoming when we need to bottom, or even lower than we need to bottom to maintain that trend. So one day's action doesn't mean a whole lot. Today doesn't mean a whole lot. Tomorrow doesn't mean a whole lot. What matters is what happens on Wednesday. Wednesday is when we get the Fed meeting, we get the dot plot. And let's focus on this because the market started turning at the beginning of this year. The Fed started getting hawkish at the end of last year. The market rallied quite strongly off the COVID lows when the Fed stepped in, provided liquidity, and stimulated the market. So the Fed is the driving force here. And the most common, most important saying in markets seems to be, don't fight the Fed. So we're not going to fight the Fed here, and we're going to ride the wave with the Fed. So what will the Fed say on Wednesday? And what does that mean? What we expect the Fed to say on Wednesday. They have been hawkish. They've been ratcheting up the hawkishness. On the last day before the blackout period began, Jim Bullard said, even if we get a good CPI report, the Fed will still be hiking rates aggressively. Well, guess what? We got a very, very bad CPI report. So the Fed is going to deliver hawkishness. Now, people say the market's expecting hawkishness. People say the market's expecting 75 basis points. Listen, they're not expecting it enough. They're not expecting a hawkish Fed enough. JP Morgan just said stocks are bottoming out because the Fed is going to have to cut rates in 2023. The Fed is not cutting rates in 2023. They've been saying, even if inflation starts to come down, they're not cutting rates in 2023. If anything, they're going to cut rates maybe in 2024. But guess what? Inflation's not coming down. It's increasing month on month. We just had record food inflation in August, not in July when everyone else said it was peak inflation. We went through August saying it was going to be peak inflation. And guess what happened in August? Fed Chair Powell came here and hammered hawkishness. Or rather, beginning of September, hammered hawkishness. So that's what it is. That's what it is. Don't get too bullish. I'm not buying stocks. I'm remaining negative. I'm adding to shorts. I'm prepared to add to shorts as they continue to rise. I'm not going too hard on this. We are down. We've had a big fall here. But I have a new client coming in. And seeing some rally today from his point of view. I'm going to put that capital to work, nibbling on some shorts. Now, don't buy stocks. There are some stocks you can buy. For example, energy stocks. Energy stocks were down big this morning, almost all across the board. WTI was down almost $3 a barrel. It closed the day up. Okay, this is another reason not to buy stocks right now, in my opinion. WTI is artificially low. The White House said they're going to do 10 million barrels of strategic petroleum reserve in November. They don't really have a whole lot of ammunition left. Okay, that's why it's just 10 million barrels. 10 million barrels is not that much. I get it. The economy is slowing. Maybe consumption is going to go down. OPEC is cutting consumption. The more strategic petroleum reserve gets released, the less companies invest in new production, the more likely OPEC is to cut production. We just saw their forecast missed by 3.8 million barrels a day. The strategic petroleum reserve for last month, I believe. The strategic petroleum reserve is unloading 10 million barrels in November for a month. For a month. OPEC is missing by 3.8 million barrels a day. So WTI does not seem to be crashing here. Energy companies do not seem to be crashing here. And if they do, and if they show signs of that, those, in my opinion, are stocks you can still buy. So I'm not saying don't buy all stocks. What I'm saying is don't load up on tech. Don't expect a mega rally. Don't expect that. I don't see any reason or any catalyst for that. I get it. People are defensive. People are positioned defensively. I get it. Interactive Brokers has tremendously high cash values. Let me tell you something. If I had a tremendous amount of cash right now, I would not be excited to buy given the macroeconomic environment. So I think cash is going to stay in cash. And guess where I think that cash is going to go? To bond yields. That's the whole point here. That's the whole freaking point. When yields go up, the return on cash goes up. It makes more sense to hold cash. Inflation's coming down when yields go up, hypothetically, even though it's not, even though yields are up, okay, not a good picture yet. But more importantly, you can just lend that money to the US government and get a better return back. Unlike the past several years, you're finally getting the best return you've gotten in almost a decade. So there's a place for this cash, and unfortunately it's not in stocks, at least not yet, at least not in tech stocks. Maybe in energy, it makes sense. Maybe in some, bond ETF, it makes sense. But right now, not in stocks, not in the mega cap stocks, not in the expensive stocks. The market's still trading at an above average historical multiple, and it's not the best environment to put new cash there. So we'll see what happens Wednesday. Things are subject to change, but that's today's video. And until next time, peace out.